Spend time understanding how founders think about their business and how they're going to grow their business, how they're going to hire people. What are we paying people to do these jobs? These are long-term relationships. Understand that it's a two-way street. It's not just, hey, a venture investor wants to give me money, great, I'll take it. Is this someone I want to spend time with? Is this someone who I think is going to be helpful? Is this someone who I think will provide value over time?
David, thank you so much for joining our startup fundraising podcast today. I would love to take the opportunity, especially as you are a general partner at August Capital and have invested in like really awesome companies like Splunk or Fastly or Bill.com to think and learn about how you think about investing into other companies. Let's start with looking back at your last 20 years of a track record as investor. And I assume you are looking at 1,000 plus companies every year in order to make a decision on whether to invest on it or not. Let's say 20,000, 50,000 companies that you've seen. You've declined most likely 99.5% of those. Out of those that you declined, let's name like 5 or 10 of those where now they are $1 billion companies and you declined them when they pitched to you.
Yeah, I mean, there've been a ton. It's just, I mean, if you're lucky enough, you get to see amazing companies, and anyone who's been in the business for any reasonable period of time and has seen great companies has turned down great companies. I was the previous investor to both of the Uber founders' companies and was pitched on the Series A of Uber by Travis. And at the time, all they had was Uber Black, and I didn't think it was a big enough business to build a giant public company. Right. I was wrong about that. Turned down that one. Saw both the Series A and Series B of Twitter. Spent time with them. Was one of the earliest Twitter users. Turned down Twitter foolishly. Absolutely kills me. I spent a bunch of time and got to the point where I was ready to give a term sheet to Datadog. And at the time, we were not really investing in New York companies. And so we didn't end up funding it. Good friends with Reid Hoffman, who said, hey, you really should fund my Series B. Spent time talking to him and turned that down. I mean, just the list is too long and too depressing.
So if I look at the startup world, I mean, you could, as an investor, do like alpha errors, which is from my perspective, like you're investing into a company and then it turns out it's a shit company. Yeah. Or doing the better error, which is one you did not invest and it turns out actually it's a great company, which we're briefly talking about. In the case of Uber, so did Travis not communicate his long-term strategy in terms of expanding the ICP and business model? Or did you talk about this at all? Because if I were a founder and I would talk to investors, I would try to communicate my bigger vision. And then, okay, we are starting with small market, like luxury black cabs. But still, we want to expand into mass market taxis, maybe other types of mobility or something like this. Was this missing in the story back then? Or why did you decline to invest in this?
Well, if you look at it, right, this was ultimately Lyft had the realization that you could just use the average driver in the average car. And they were getting around a bunch of regulations by pretending that they weren't charging for it. You would just tip, which was an interesting but kind of non-existent differentiation. And then ultimately Uber saw that as their real big opportunity, and they were willing to fight the regulatory fight that got them to be able to be of the scale they are today. But at the time, they really weren't. They weren't there. It was slightly more complicated than that, which is that Travis was out talking to a handful of investors. He was really digging in quickly with Benchmark. I give Bill Gurley and Benchmark credit. They spent the weekend with him. I caught up with him briefly on a Friday before a long weekend. He said at the time, look, I'm going to, I worry that I'm not going to be able to wait until our meeting with your full partnership on Tuesday. And we had a conversation which said like, oh, are we going to blow this by letting him spend the weekend with other investors? And we just decided that we didn't think that the business was a big enough business. I don't think it was really a Travis problem. It was more of there was a lot of speed and activity. Yeah. And by the time the weekend had ended, Travis had signed a term sheet with Benchmark. That was for sure on me. I was perfectly clear that Travis was having these conversations and that it was very possible that he wouldn't make it through the weekend. When he emailed me that Monday and said, hey, unfortunately, I've already signed the deal, I said, Yeah, I'm not surprised by that, and congratulations.
If I'm looking, I mean, it's just execution on a VC fund part, so to speak. Yeah? I mean, if you are too slow to close a deal and the deal's already closed because there was high investor demand, okay, you're a little bit too late to the table. Of course, this is more in your control, how you set up the VC fund, how you set up the decision-making process, and so on and so forth. What advice can you give to other VC funds or to enlighten founders so that they understand a little bit better your decision-making process on how you minimize the alpha error and the beta error when doing investments?
Well, I mean, look, at one of the problems is that speed is not actually your friend. For a period of time, companies were moving so quickly that I really don't think venture investors were doing proper diligence. They weren't spending enough time with founders. They weren't talking with people who'd worked with them before, et cetera. But the best way to minimize both of those errors is to spend a lot of time with the team, to talk to lots of people who've worked with the team, to fully understand, are these amazing people who will run through walls and who are inspiring others and all of those things. And the best way you can do that is to have the opportunity to see them in action, right? So our process when we get excited about a founder is to get them in front of potential customers, people we're close with, and say, hey, go pitch your business to these people. I'd love to hear what they think, right? And the really great companies emerge with new customers. The people I introduce them to say, oh my God, that's amazing. I want to spend time with them, which is an extraordinary signal. In some instances, what you hear is, no, I like them, but I didn't think it was a very big opportunity, or I didn't think it was transformative, or we have other priorities, et cetera, which is a very important piece of information. So, there have been times in the venture cycle when there's so much demand, there's so much interest that things move in a weekend, right? And I actually think that's a bad trend. In this instance, Uber got funded in a weekend. I think that I'm sure that the Benchmark team was doing a bunch of work and et cetera. I knew both Garrett and Travis at that point, so I actually could have moved very quickly. We just didn't. Look, sometimes you're just wrong about the scale of an opportunity. In this instance, that's where we were.
If you look at for example, the signals that you're collecting. Of course, if you're a very early stage, you don't have lots of operational metrics that you can look at. You don't have like 3 or 4 year kind of hindsight and can see, okay, how the metrics are moving and so on and so forth. You're basically, I would say, like blind on one eye. And now you're looking for other signals. You just told me, and this is what most VCs that I spoke to are doing, referring potential customers to see whether there's some kind of positive customer demand signal for them. Yeah, because you can easily, for example, refer like 10 customers. If they are in their ICP, and then like 40% of those get back and say like, wow, crazy opportunity, great offer, great value proposition. Where can I sign and pay money? Yeah, then of course you have some great demand validation. What other validation tactics do you use in order to build conviction about investing into a company?
Well, like I say, I am a Series A investor, maybe late seed. You've raised some money. I am looking for some evidence of product market fit. You should have gotten in front of some potential customers. We should have some indication that the thing you're building is of value to someone. And so ultimately, I will speak with your early customers, but they're very early, right? I mean, it's, having a handful of customers is very different from having 100 customers in the enterprise business or 100,000 users in the consumer business. And so really, I'm a people investor. I'm spending time with the people, trying to understand how they think about their business and how they think about the market they're chasing and what they've done in the past and what they'll do in the future. And, late stage investing is a very different thing. Do it. I have late stage investors follow on my companies, and by the time they do, they're looking at metrics that are just different, right? I mean, the most important metric for a late stage SaaS investor is net revenue retention. Are you signing up a customer and then they're paying more the next year and more the next year? And my best companies have, positive net revenue retention, 140%, 150%. That's an incredible indicator that the product you've built is compelling. But when I'm funding them, you have a couple of customers, you have an alpha customer, you have, whatever. It's not, you don't have that kind of signal. And so I'm really betting on amazing people.
And when you look at your deal flow, and then especially the companies that you actually invest in, what is the average time of you having a relationship built with those type of founders, like 3 months, 6 months, 12 months plus, whatever? Did you meet all of them that you invested in like for multiple months locally, indicating that basically it means you would need to live close by in order to build relationships with investors, which would mean that you need to move to San Francisco, New York, or other major investment hubs? Or do you think like during Corona times, this changed a little so that there's also more and more relationship building actually done via Zoom or email or some other virtual type of relationship building?
Almost everybody I fund, I guess, yeah, essentially everyone I've funded has been through either a direct relationship, I knew the founder already, or through a mutual relationship. Someone I know and trust says, this is a great entrepreneur and you should spend time with them. In some instances, I've spent a bunch of time with them. I was introduced to the Splunk founders by their attorney, who was the attorney for another company I'd invested in. I trusted him, a guy named Mike Patrick. He said, you'll like these founders. And I spent the better part of a year with them because their first thing they were working on was early. They were thinking about it. They shifted what they were focused on. And when they shifted to the thing that became Splunk, I said, oh yeah, that's really interesting. And I had spent a bunch of time with them. But many of my founders I get introduced to, my most recent investment is in a company called Vantage Discovery. These really smart founders who are experts in search and in bringing kind of AI embeddings into the search world. They had built a company that was bought by Pinterest, and they built the search and monetization layer for Pinterest, which was wildly successful. And I got introduced to them through two different angles. One, a founder I was really good friends with, known for more than a decade, who was working on a startup and partnering with these founders and was like, these people are amazing. And so that's, very, very good connection. And another instance was connected through the former head of product for Pinterest, who was someone who I had spent time with, who had come to my lobby conference, this gathering that I run. And he said, oh, these are some of the smartest people I've ever worked with. And so those two introductions triangulated. I spent time with the founders. I thought they were spectacular. I did a bunch of reference checking. Everybody they'd worked with thought they were spectacular. I talked with their early customers. I introduced them to customers. Everybody thought they were spectacular. And then I had to spend time with them. But just for the record, one's in the Bay Area, one's in Texas, right? I had to get together. In fact, I said to the one in Texas, I'm going to fly to Austin this weekend. Can we get together? And his response was, I'm going to be up in the Bay Area next week. Let's catch up. We had dinner with the two founders. It was a great dinner, etc. And I gave them a term sheet. So sometimes you've known, when I funded Bill.com, the founder of Bill.com was the very first founder I'd invested in at a company called PayCycle. I had already worked with him for 6 or 7 years. I've now worked with him for 24 years. If he were to start a third company, I'd fund. So it just depends on the founder.
How do you go about investing? Is it like really heavy investment thesis driven that you carve out 1 or 2 investment theses and then you are hitting? And then you are basically looking for founders. Hopefully somebody will turn up. Or second approach would be, you will be introduced to some high quality founders like you just described, and then just look at them and see, okay, is this one of the baseball bats I would like to play or not?
I don't understand thesis investing because it suggests that venture investors are smarter than entrepreneurs, and that's decidedly not true. If venture investors knew the future, they'd go start that company, right? Yeah, you'd rather be Mark Zuckerberg than David Hornik. My belief is that founders see the future, and if I have the good fortune to hear their description of the future, hopefully some of the time I'll recognize that it reflects what we're going to see in the coming technology. And so like I said, one of the principal ways that I engage with this broader community is that I run this set of invite-only events, one in the consumer space, one in the enterprise space. They're called The Lobby. And it's a gathering of, a bunch of very smart founders and investors who talk about the things that are important to them. And some of the time we talk about things that will ultimately turn into the trends of the future, right? We very early on had conversations about blockchain and cryptocurrency, and a bunch of that stuff came to fruition.
Mm.
Very early on, Matt Mullenweg, the founder of WordPress, was talking about distributed teams and the no need to have an office. And sure
Yeah.
enough, then we ended up funding GitLab, which had no office, and we had gotten comfortable with the idea because we'd heard it through Matt, and Matt ended up being an advisor to that company. So, and there've been tons of these trends, where people, really smart people, sit around and say, so artificial intelligence is a great example. So I have lobby consumer and I have lobby enterprise. At one of the very first lobby enterprises, this year will be the 10th year of lobby enterprise. So we're talking 8 years ago. We had an
Yeah.
extraordinary conversation about the future of machine learning and artificial intelligence. And the conversation very much was like, oh, what is different about artificial intelligence? It became a conversation about quantum computing. The head of quantum computing for Google was there, and he said, look, ultimately, to get to the scale we need, we'll need quantum computing. That turned out not to be true. It turns out GPUs and the scale of GPUs is sufficient. So we have these conversations where smart people are describing what they think the future holds. And that becomes the background context for every conversation I have. Then I get introduced by these very smart entrepreneurs to people they think are inventing the future. I listen to the story, and in the context of all those things I've heard, I've been now a venture investor for 24 years. What have I heard over those 24 years? And the years before that, I was a lawyer representing these companies, right? So I have a lot of context. And then you hope that when Uber comes to you and describes the future of mobility, you go, there it is.
And can you name me some kind of implications that, for example, AI is having right now on consumer or enterprise SaaS companies?
Well, look, and I think that on the one hand, it's it's touching everything, right?
Yeah.
There isn't a board meeting I have in my existing portfolio companies that doesn't talk about artificial intelligence. There isn't a pitch I receive that doesn't talk about artificial intelligence. And which is amazing, and it's powerful stuff. But for what it's worth, there was a period of time when there was not a single meeting I would have, there wasn't a single introduction I had where there wasn't some discussion of big data. When suddenly it became clear, like, oh, well, there's an infinite amount of data, and the best companies are going to be informed by data, etc. And so data awareness and big data became this extraordinary and important thing. It had been years before that I funded Splunk, which became the first, kind of platform for big data. When we talked about Splunk in the first instance, we weren't talking about big data because there was no such thing. We were talking about the proliferation of log files, which was just the early indicator of big data, right? So, for a period of time, every company was a social company. Like, okay, here's this application, but now we're going to connect it to your relationships, and that's how it's going to be better informed. So I think AI is just another piece of that evolution. It's a powerful piece. I think it's, in many ways, the most powerful transformational technology we've seen since the internet. But look, the internet was that, right? Oh, actually, everything's going to be connected through the internet. And boom, it exploded. And then people are like, well, that turned out not to be a thing. And of course it was a thing. And now everything is connected to the internet, to the cloud. And the same thing is true of artificial intelligence. So when people say, oh, this is a great artificial intelligence company, I say, that's not a thing. Like, the fundamental artificial intelligence companies, the open AIs of this world, have been built for years now. The question is, how are you applying this in some thoughtful way to be a great CRM company, to be a great recruiting company, etc., that's powered by artificial intelligence?
If you're looking at the startup landscape for AI, for example, I mean, you see different things. You even see like hardware AI startups who try to develop new type of kind of GPU chips, but like ACID to reduce the costs for doing calculations in the data center or something like this. You see like the typical LLMs like OpenAI or Perplexity AI, something like this. And then you see some minor use case specific conversions, whether it's in the text prompt to text space or prompt to audio space or video space, etc. But from my perspective, very, very like infrastructure heavy. And not extremely heavy on a specific value driving use case. So my question to you is, did you already see some kind of shift so that more like value and proposition focused AI companies are? For example, when I look at text to video conversion, I'm thinking like, okay, you do a very broad technical solution, which has so many edge cases which you need to solve, which means your average value to your customers will be low. Why are you not going for one specific use case, for example, ad creation, and then competing against the big agencies in this world? And you would not be providing the tech platform, but you would be just a tech-enhanced service provider. And then just saying, okay, guys, we are competing not with other technology companies. No, this is not our game plan. We are trying to be the best ad creative producer using AI, but nobody really cares about that it's technology. I don't care. The value proposition is more like, okay, we do a faster ad creative creation. We have a more personalization approach, because now you can do not just one spot, which you can do, but we do with different buyer persona, with different regions, etc. So you are not ordering one advertising spot, but you are getting 5.
Yeah. Reality is that there's this interesting dichotomy, right? Which is what you describe is right. Like it is easier to attack a vertical because you're solving a very specific problem. You can use marketing that's more pinpoint, etc. Vertical applications tend not to be sufficiently large to make sense for big venture investors, right? If you have a multi-$100 million fund, the companies you fund need to be billion-dollar outcomes in order to drive the kinds of returns you need to justify the investment. So in the end, what you're looking at is this interesting challenge of, I get this thing. I think it's interesting. I think it's solving a core problem, but it is broader than that. It can be big and exciting. Virtually everything I hear either is like, here's a big picture and we can solve this big solution. And my answer is, okay, and where are you going to start?
Yeah,
like that's
right.
Splunk. If you look at Splunk, it isn't that Splunk said, hey, we have this data solution that you can literally use for everything, which is what Splunk is today, right?
Yeah.
Is, hey, consume all your data and you can do all sorts of things. It was, we have this data platform. We're going to use it for system debugging. Like if you want to understand what's going wrong with your systems, Splunk is the best way to do it. Then it became clear once you were using it for that, I can use it for security because I know a bunch more. Then you understood you could use it for compliance. Then you could use it for all these other use cases, et cetera, right? I funded this amazing company called MaintainX when it was very small. The founders had built this application that said, hey, in order to maintain systems very broadly, you can create essentially a digital checklist. You go on and you say, here are the things I need you, the worker, to do. It's on your smartphone and you say like, here are my 17 tasks. I did this one, I did that one. You can measure things, you can take photographs, etc. And their first 100 customers were extraordinarily diverse, right? They had, McDonald's, they had hotels, they had big engine manufacturers using it to manage engine manufacturing. It was like, that was one of those instances where you're like, well, this is obviously extraordinarily broadly applicable. How are we going to sell that, right? Are we going to go and get every McDonald's owner? Or are we going to go and get every manufacturing company? Now fast forward that was the first 100 customers. Today, they have thousands of customers and they are managing the operations for all of the plants of one of the biggest concrete manufacturers in the world. They're also helping to manage thousands of quick serve restaurants like McDonald's. They're also being used to manage all sorts of operations for things like cruise lines or governments, etc. That's one that's amazing, where it has very, very specific vertical applications and has extraordinarily broad horizontal applications. What I would say when you, in your description of like, hey, you use AI and you do the server point thing or whatever, is when you are using someone else's technology to deliver the magic of your solution, it is hard to build a defensible business that has a big moat. Yeah. And one of the things we look for when we see a company is, okay, what of your technology or your customers or your relationships is going to make it harder for the next company to compete with you. And we're seeing lots and lots of things that say, hey, I use ChatGPT and it does this amazing thing. And it's like, that's great for ChatGPT. That's going to be amazing for them. In the same way that lots of applications that sat on top of Facebook were great for Facebook, right? But didn't end up being great for those applications, etc.
You look at founders. What are the top 3, 4, 5 signals that you are looking for in order to determine whether it's a great founder or not? And is it more like really person related, or is it more like you described before? Okay, I'm checking, is the solution creating demand? Because therefore I can imply that the founder is not totally stupid because he is able to calibrate a great offer, for example. What signals are you looking for?
Well, because I'm super early, it tends not to be about, oh, this is a product visionary. It tends to be about, this is an astonishing entrepreneur. So what is an astonishing entrepreneur? Well, they tend to be, first of all, they're very good salespeople. And there are lots of ways to sell. So it doesn't mean you're very salesy. It doesn't mean like, I can tell a big story, showmanship and all that. But you do need someone who can say like, oh, let me explain to you how I see the future and why I think it's a big future and why it's exciting. And in many ways, the best judgment, the best way to see that is, have they convinced people to do things, right? Have they convinced customers to try a solution that's really, if you're building some infrastructure software and you've convinced a big company to do it when it's just getting started, that's pretty amazing, right? If you've managed to convince great people to leave other jobs and join you, that's amazing. I funded this company called Pharos AI. It's this very smart platform that allows software engineering teams to better understand end to end what's happening in the engineering team. Who's creating great software? Who's the most efficient? Is it buggy? All these things that you need to know if you're going to manage it. The founder had been the person who was running Einstein at Salesforce, the AI platform. But the thing that was compelling when I spent time talking with him is I said, well, how many of the people who are you working with from your past organization? The answer was most of them. He had dozens of folks he had worked with before who had rejoined him to help build this Pharos platform, right? His co-founders were from that team, and then they had dozens of people who had joined them. And I said, great, introduce me to someone who didn't join you. And I talked to some folks who had been in the group before but not joined. And I was talking to one woman. I said, well, you say nice things about this team and that they're smart and great and blah, blah, blah. Why didn't you join them? And she said, well, I had other opportunities that were important and focused. But for what it's worth, I introduced my boyfriend to them and he works for them. Like, oh, well, okay, that's a great team that you can create so much excitement that people are diving in and getting involved despite the fact that there are plenty of risks associated. So, I'm spending time with founders. I also think great founders absolutely understand their market end to end. So if you ask them about the competition, etc., you'll get to know everything you need to know about them and about the market because they will be the world's expert. My partner, Dave, who founded August Capital many years ago, told the story of why he invested in Microsoft. He was the only private investor in Microsoft. He sat on that board for 33 years. It's like, well, he was talking to everybody who was building software at the time. So why did he invest in Bill Gates, who at the time was like a 20-year-old? And he said, when I talked to Gates about everybody else's business that I was meeting with, he was smarter about their businesses than they were. And so ultimately it was like, I don't really have a choice. Why would I fund them when Gates is smarter than they are? But I should fund Gates. That obviously worked out well. By the way, you at the outset of this thing, you said, hey, this is David Hornik from August Capital. I'm actually now from a firm called Lobby Capital. And here's the evolution. I joined August Capital, this amazing firm, in 2000. And we were at the time investing our third fund, August 3. And for the next 20 years, helped to build August Capital through August 3, August 4, August 5, August 6, August 7. And at the end of August 7, we'd fully invested August 7. I'd been there for 20 years. I sat down with my partner, Eric, and I said, okay, if we were to reinvent who we are and what we do here, what things would we change, if any? And we decided, given the scope of this lobby community that we'd built, And,
Yeah.
and the importance of this group of founders, 2,500 amazing people who'd been part of the community, that we thought it better reflected what we were doing. And so we renamed the firm Lobby Capital. And we
Ah,
really refocused our attention on we're Series A investors, we're going to be lead investors, we're going to keep the firm small and focused, and that's what we're building. We launched Lobby in 2020, and we're currently raising our second Lobby fund, and we're busy building the next generation of August Capital, which is called Lobby Capital.
great. Awesome. I guess this does not mean that you are investing into government tech startups.
One of our most exciting companies in our first Lobby Capital fund is in fact focused on a bunch of interesting government solutions. It's a company
Okay.
called Hidden Level.
If you look at startup, one way of how you could look at it is how capital efficient are they and how fast are they able to deploy the capital efficiently. How do you validate this? Because if I were trying to put myself into your shoes, this is what I would try to understand. If I give them a check of, let's say, 2 million, 5 million, 10 million, are they able to efficiently and fast deploy my capital? Because if it's just sitting on the bank account, why should I charge 20, 30, 40% ARR for that?
Yeah, I guess I take a slightly different view of it, which is you want them to be efficient, you want to be thoughtful about deploying capital, but you want them to do it in a way that's leveraged and creates value. Right now, I'll tell you, the great companies are being extraordinarily careful and thoughtful about how they deploy capital because it's very hard to raise capital. And so and ultimately the only thing that can put you out of business in the startup world is running out of money. And then on the other end of the spectrum, you have companies where they're amazing companies. They're making great strides. People are excited to give them money. This company MaintainX that I described for you, just raised tens of millions of dollars at $1 billion valuation from Bain Capital, a fantastic firm. But the last thing you want them to do is then triple the burn, and unless they have some really efficient way to acquire customers, and we're growing the team well, etc. So it's always a balancing act. And the best you can do is spend time understanding how founders think about their business and how they're going to grow their business, how they're going to hire people, what are we paying people to do these jobs? If you pay people too little, they're going to leave. If you pay people too much, it's not a good use of their capital, etc. So it's always a balancing act.
Maybe this was not clear. I think the same way. And when I say efficient, that's why I'm saying not burn through the money like an idiot, which is what many startups are doing, because they either overestimate the customer lifetime value, or they just think, okay, I need to push my feet to the pedal so that in like 12 months or 18 months I can then raise the next round. But if I do not be able to raise my round and I increased my monthly losses, then of course my company will be dead. And then this was a bad, so to speak. How do you validate this during the due diligence process? For example, if I would want, for example, I saw an AI company and they raised like $1 billion and they are a team of like 30, 40 people. They have like a plan of maybe adding 10 or 20 more people. And I'm like, okay, did you just raise the money for the next 30, 40 years? Or what is the plan here? I mean, if you want to
there's a lot of silly behavior going on, but for what it's worth, right, it's very possible that the processing costs of AI are so large that their demand is requiring that they spend a lot of money on on GPUs in a way that maybe will burn a huge amount of money but create a real moat and give them opportunity. That's not the kind of company I fund. I am not a momentum investor. I'm not someone who thinks like, let's go big or go home. I fund founders who are going to build fundamentally valuable technology, and then I'm going to help them build go-to-market teams in a rational way that proves it out. But ultimately, look, it's very possible that you discover, we have an incredible value proposition. We can acquire a customer for X number of thousands of dollars over a period of 6 or 9 months that will be a customer for the next 10 years. That customer is extraordinarily valuable. But in order to capture them in the first instance, we're going to have to put a lot of money to work. We're going to have to build a big sales team and a growing sales team, etc. And that's great. Okay, as long as you can understand that the model works. At some point, you're going to take this company public, And Wall Street is going to say, okay, you're unprofitable today because you want to grow faster, but at some point you're going to be a profitable business.
Yeah.
And for a dozen years, the market was only rewarding speedy growth. And
Yeah.
then
Right.
in a heartbeat, the market said, we only reward profitability. And all
Yeah.
these companies that were investing huge amounts in growth had to pivot, and it was
Yeah.
very, very hard. So it's always this interesting question of which thing are you trying to do?
And if you look at those LLMs, one quick thought came to my mind, which is like, okay, normally you are investing either into advertising or people or hard assets, so to speak. If you are talking about, for example, raising $1 billion with the argument of saying, okay, we need to buy 10,000, 100,000 GPUs, why are you using equity investment for that, which is shitloads expensive, and not alternatively, for example, doing something like inventory financing or going to NVIDIA and tell them, guys, we would like to get a loan for, like, say, 60, 70% of asset value, and the rest we will only finance, for example, with the equity portion, because thereby we are reducing our average cost of capital. I mean, I don't know whether those people are thinking like that, but I would be thinking like that because I can then retain more equity for myself and don't spend it on assets I could finance much cheaper with an alternative form of financing. So
Yeah,
not
I
like,
guess it depends, to tell you the truth. I mean, obviously, if you're building if you're building physical plant, it is certainly
yeah,
possible that you could use debt financing to drive that. And I do think that, that smart startups are trying to understand what are the relative risks and associated values of debt and equity. Look, debt comes at a cost. If it turns out as a company you're running low on capital and you have debt providers, they very quickly will own your company.
yeah,
Equity is very different. You could have lots of equity holders. You're getting close to that point where you need to raise more money. You're running out of money. The equity holders don't have the capacity to come in and say, well, we're taking your assets. So debt comes at a real cost. You have to be thoughtful about that. The other thing is, debt providers are looking for real predictability, and early stage startups are not particularly
yeah,
predictable. So just because you're an exciting LLM provider that's creating next generation video creation or whatever, and the venture world is excited about what you're doing, doesn't mean that you're going to be able to go back and you've made $10 million in service fees over the last year. It can be hard to raise $100 million in debt based on that kind of past cash flow. I think that eventually everybody gets to the point where they have sufficient predictability that they can measure the value of equity versus debt. But in the
yeah.
early days, it's very hard to use debt as an alternative when you don't have the kinds of predictability you need.
Do you only look at software companies or also hardware companies? For example, like data centers who are more focused on AI generation? Because what I saw also was like AI focused or GPU focused data centers, which then makes me want to explore, like, okay, what is the best actually location for getting cheap electricity, cheap parts, maybe how to optimize the whole data architecture in this data center, and then just go to OpenAI and all the other big companies and tell them, guys, you run your operations. We are your hosting center, basically. You run your LLMs on our side, and you are saving like 20% of all your operating expenses. Did you see something like
But
this?
I'm sure there are businesses out there trying to solve this problem, etc. That's not what we do. I'm largely a software investor. Even when we invest in hardware related businesses, the principal value is coming from the software associated with those hardware products. We're not investing in chips. I think that's a very different business. We're not investing in services businesses. It's a very different business. But one could build an amazing business by using software that drives value. We have hardware related businesses, but the smarts of those businesses are for sure coming from the software.
Any last tips you would like to share with founders who are trying to raise money right now for their startup?
I think that the thing I would say is, it's one thing to have to go out there and try and convince people, hey, you should give me money, but they should be thoughtful about it too, right? If you have the good fortune to be pitching a business that more than one investor is excited about, do your own work to make sure you know who you want to work with, right? Because I've worked with, as I said, Rene Lacerte, the founder of Bill.com, and before that, PayCycle. Rene and I have been working together for 24 years. I sat on one board for 15 years. I sat on the Splunk board for 13 years. Like, these are long-term relationships. Understand that it's two-way street. It's not just, hey, a venture investor wants to give me money, great, I'll take it. Is this someone I want to spend time with? Is this someone who I think is going to be helpful? Is this someone who I think will provide value over time and be a partner, etc.? So just do the work. Make sure that you're joining forces with someone you're excited to work with for the next 10, 15, 20 years.
I mean, bad investors can definitely destroy your company or kick you out or do some other shenanigans. Of course, I mean, we have seen this in multiple cases.